Well, let's talk about it as investors, because that's what we are here. Twitter is the most miserable investment you could have made in the last decade. You've made no money in 10 years. The rotating door of management there, giving themselves lots of options. Each team, more options. Zero value created for shareholders in 10 years. A board, prior to being taken over by Elon Musk, that didn't even use the product. I mean, that in itself is bordering on criminal, if you ask me. They don't even know what the product does, and they're sitting on the board of the company. It was a miserable, miserable, miserable investment. And finally, someone comes and puts them out of their misery. Those shareholders basically got their money back after sitting on this dog for 10 years. Now, having said all that, I think there's better times ahead for Twitter, because Elon wants to bring back the idea of an open cry forum that has all sides of the debate on it. That's important. Because what Twitter was doing was just indiscriminately canceling voices and losing millions and millions of subscribers. I mean, I can't think of a worse management team there. And I hope he just gets a spatula and cleans them right out, because they were useless. Now he has a chance to take this platform, which is global. He's been using it for free advertising now for 7 years. That's why Tesla spends no money advertising. He just puts it all out there on Twitter, which then feeds the rest of the media. And that's the remarkable thing. But I think because it's an Elon Musk story now, people will pile back in to be part of the fray. It'll be an open cry forum. Yes, there'll be the lunatic fringe. There always is. That's about 2.5%. But let's see if we can put new features, make it more exciting. The platform was boring. That's why it lost so many people. Now let's see what he can do with it. It can't get worse. It cannot get worse than what it was. And finally, somebody went in there and cleaned it out, and that's a good thing. You know, the real issue and why the market's fibrillating and trading in a range is nobody knows what percentage of inflation, let's call it 6.5%, is actually transitory and how much is baked in. So the assumption now, there's a lot more data on supply chain, and I'll give you some interesting data points. Shipping rates, in other words, if you want to book a container from the LA port to Chicago, those have dropped 35% in the last 6 weeks. So there's a supply now of trucks and drivers. That's a good thing. On the other hand, getting the actual product into the LA port has not improved at all. So there's lots of evidence here that some portion of it is transitory. That's why you really haven't seen rates back up too much yet, because the Fed is probably, although they're jawboning another 50 basis points, I wouldn't be surprised if they did only 25 basis points for the next hike and then just waited to see what would happen, because it's hard to call recession right now when you have full employment. We've got full employment. Try and hire somebody right now in any sector. There's just nobody to hire. And so generally speaking, if you're going into recession, you get a dramatic slowdown. The first place you see it is in wages and employment percentages. And right now we're below 4% unemployment. So I don't see a major correction. I just see a lot of volatility ahead. And the truth is about crypto, it's not yet an institutional product. There's a lot of good signs. Let's start with the signs of the different bills going through the bipartisan committees in the US on the Hill. You got the Haggerty bill on stablecoins. You got the Toomey bill on stablecoins. You have the Loomis bill, which contemplates all crypto. All of these things are moving forward. You had the announcement last week that BlackRock put money into Circle, which is USDC. And then Fidelity this morning, or late last night, announcing that they would allow in their 401k retirement programs up to 20% in Bitcoin and other certain coins. And so clearly the movement is towards putting policy in place on crypto. That's positive. Now, the negative is Bitcoin 2022, a couple of weeks ago in Miami, they had to open a special day just for institutions on Wednesday. 1,500 institutions showed up. None of them own any cryptocurrencies. They're trying to figure it out. They know it's coming. They know policy's coming. Tomorrow, the FTX conference in Nassau, it is sold out globally. Governments from every state and country showing up there. I've never seen so much interest in an asset class that nobody owns. The truth is the whole sector is, Bitcoin's under $1 trillion, which is a nothing burger in financial services. So there's a lot of upside to come. And I think cryptocurrencies, you have to make one decision. Do you go long before the policy and regulation hits, or do you wait until the institutions can buy and pay significantly higher prices with more certainty? And I think that's the debate everybody has to have. I've made my decision. I have gone into 20% holdings across a wide range of crypto and crypto infrastructure like WonderFi, Immutable Holdings, FTX. and so on. Those are the equities I own, plus 32 other coin positions. Well, I think we should talk about the environment right now. GE just put out some numbers, stocks down 9%. The energy space has been very, very volatile, but there's another thing to watch for right now. I don't know if you saw it, but 3 weeks ago, the SEC put out a memorandum, and what it said basically was they are going to propose carbon neutrality audits. So in the same way that if you're a public company, you're trading on an exchange, you have to give financials every quarter, and they have to be audited by an auditor and signed off by that auditor. Then you issue them to the public, and that's been going on for decades, and that's how it works. Now they're introducing the idea that not only do they want financial audits, they want carbon audits. Now, this is where it gets complicated for the entire energy sector. We can see where it's had impact on stocks. Let me give you an example. Most Bitcoin miners, which is a very energy intensive activity, and you can look at other sectors too, because this is going to apply to all 11 sectors of the economy. But Bitcoin mining is a really good index. Prior to this memo from the SEC, people would index. They'd own Hot 8, they'd own Marathon, Riot, Hive. These names were an easy index to Bitcoin. If you were an institution, you couldn't own Bitcoin, you could buy the stocks. The SEC memo comes out, and basically what it says is if you claim that you're carbon neutral, which all of these Bitcoin miners do because they buy carbon offsets, but they use traditional power that's in many cases flared gas or burning coal or whatever you have. The problem with carbon credits, and everybody knows this, basically they're BS. There's no auditor that is going to actually sign that because they know the SEC is watching, and there's no ledger to carbon credits. You say, oh, I bought a square mile of the Amazon rainforest, offsetting my mining activity. Doesn't work. So those stocks have been absolutely crushed, and they're not going to come back. Yeah, it's amazing. And a lot of these down 50, 60, 70, 80% stocks have not stopped growing. Their growth rates remain the same. It's just what people are willing to pay for them has changed dramatically. And I want to point something out. Prior to the pandemic, in the tech sector, there was always a lot of volatility. And the granddaddy stock that teaches the lesson of volatility, I ask everybody to go back 15, 17 years, is look at how much Amazon corrected every year. Down 30, 40, 50, 60% annually. And then came back up. And we got used to that. And then all of a sudden, the PPP programs and the $4.5 trillion in the printing press happened, and flushing the system with liquidity during the pandemic, that stabilized all the FANGs. It was the go-to name with all the free money. I don't care whether you had Microsoft or Google or Amazon or Netflix. It was money coming out of the sky for free, and that's where people put it, in these big growth tech names. Now we're back to pre-pandemic volatility. Doesn't mean they're bad stocks. A lot of stuff is going on sale. And I think if you look at this 12 months from now, you're going to say to myself, why didn't I buy some Facebook at under $200? Why didn't I buy some Netflix after it corrected 50% plus? What about the sale going on and lots of other tech names? And so for me, it's again, I've seen this movie before. I'm a buyer here, and you can't pick the bottom. You can't. It's just impossible. You can look at the charts, doesn't help you that much. You got to average your way in on the big sell-off days, on Fridays at 900 points down, et cetera. We're back to the old times of volatility. No big deal. We really haven't had a real correction yet. You want a real correction? Try 20, 25%. That has not happened yet.